I know we have some folks that are still rolling in here. This will be a recorded session. We're going to redistribute slides as well as the recording after we're done here today. So thank you again for taking your time out of your Thursday to sit with us. My name is Ryan Staton. I'm one of the managing partners here at StatonWalsh. Topic of today's webinar, we're going to be going over a Q3 market recap. We're going to talk a little bit about what happened in the market over the course of the third quarter, and then also unpack some other data and statistics and kind of get an idea of where we're headed from here. Talk a little bit about some considerations and some things as investors that you should be looking at as you're going forward in the market environment that we're in today. So for those that have dialed in or listened into these presentations before, you know that I like to always start things off on a lighter note. And so you get a bonus round today. There are 2 gifts in the presentation. So if you are lucky enough to see this before, you get a double prize today. So just kicking things off in my halftime presentation. So halfway through the year, I used this as kind of here's how the year started, and this is what it felt like for a lot of investors. Like, we're back, things are better than expected, the market's doing great, a lot of good stuff going on. But what's actually happened over the past quarter probably feels a little bit more like this. So if you've ever seen the movie Waterboy, then you know exactly what scene this is from. But market started off pretty strong this year. Last quarter was not it wasn't particularly bad, but it wasn't as great and as we saw in the first 2 quarters of the year. And so for many people, a lot of the pessimism and concern that existed at the start of the year has now crept back into the conversation. But let's just talk a little bit about what actually happened over the past quarter. And so when we look at performance of the major indices, so US markets on the left, global markets on the right, we see that every major indice that we track has been down or was down for Q3 of 2023. The Dow Jones, the least of which at negative 2.1%, S&P 500 for the quarter down just over 3.25%, and NASDAQ just shy of 4% for the quarter. Global markets fared about the same in terms of emerging markets actually tend to be the more volatile of the indices that we see over there, actually lost or was down the least of those major indices. But you could see there negative 2.79 and then around negative 4 for the MSCI World and MSCI EAFE, put another way, developed countries around the world. And so not a lot of excitement here, generally speaking, relatively low in terms of performance, relatively, I guess you could say, flat in a lot of ways too. Every investor probably had a slightly different experience, but generally speaking, when we look at the major indices, that we track, this is what we saw over the last quarter. So started the year off very, very strong, double-digit gains in a lot of the major indexes, and now we're back to a place where things have gone in the opposite direction, albeit over the course of that quarter. The past month has looked a little different, and so we'll talk a little bit about that later. But looking under the hood a little closer, and we look at the specific sectors of the market and how those have performed, we could see that the one bright spot was the energy sector. I don't think it's any secret that oil and gas prices have been up of late. And so most of us probably felt that. Have seen that at the gas pump. But that has translated to other parts of the market as well. And so as we transition into winter months, colder parts of the country, heating oil, things of that nature, that will become more relevant. But from a market perspective, we saw double-digit positive gains in just the third quarter alone in the energy sector ETF. You could see many of the others, with the exception of communication services, were negative. Some in a bigger way than others. So utilities, for example, is one. And then we saw the real estate sector as well was down more than some of the major indices. And so We're going to talk a little bit about macroeconomic data later in the presentation and what's attributing to some of these losses and what's kind of happening, what's changed since the first half of the year. But wanted to just take stock of what's going on in the market in general. To break things down a little bit further, and I'll kind of explain to you the purpose of this chart, but what we're looking at in this visual representation is what's going on in each sector of the market or asset class more specifically. And so when we talk about asset classes, we break things down versus, you may have heard terms like growth or value, large cap, mid cap, small cap. These are all categories that we assign to specific stocks of publicly traded companies. And we track the performance of those asset classes as well as the major indexes like an S&P 500, for example. And so this is a representation of long-term and short-term rates of return. And what I found particularly interesting when I was looking at this data is that if you look at commodities, for example, over a 10-year period of time, it hasn't been a very attractive asset class when you look at long-term total returns. But if you look at the chart and on the left side of the chart, in recent history, commodities have been the best performing asset class in many of the time segments that we have here. And so, what was interesting about that to me specifically is that something that over the long term has not gotten a lot of attention or love, so to speak, has been doing really well right now. And so it's an asset class that many investors may have stayed away from in recent years because of the long-term performance of that particular asset class. But had you owned it over the past few years, you probably have fared pretty well. The same is true for, you look at the S&P 500 finishes at the top end of that chart, U.S. growth stocks. Historically speaking, real estate, for example, you'll see 10-year average on that U.S. real estate number, but you'll see then those last four boxes to the left, it was the worst performing asset class. So there's a lot of information in this chart, I believe, and really it gets down to the idea of diversification and why that's important. Sometimes as investors, we get sucked into the idea of like picking things at the right time and trying to time the market, for example. And that doesn't always come to fruition. Sometimes it works out really well, but many times it doesn't. And this chart kind of shows us why, and that over the long term, something might not look as attractive, but in the short term, it looks really, really good. And it's something that we might want to buy, but its influence on the broader picture, the longer term planning application of owning that asset class might not be as relevant. And so to expand on that, when we look quarter to quarter, you can see that the name at the top of that, there is some consistency in certain years, but the asset class at the top of that list changes. And you could see that there's some bouncing around, that some of these, colored boxes, you could see them kind of spread out all over the place. The point of me showing this to you is not necessarily to confuse you or to make you go cross-eyed, but more importantly, to show you that predictability in markets is really challenging. Even in a 3-year period of time, you could see some of these asset classes bounce all over the place quarter to quarter. And so ability, and I'm kind of setting up here for our future conversation of ability to predict this stuff and time it gets really, really challenging, because even in the short term, as you can see, it's really, really hard to predict who's going to be the highest performing asset class, who's going to be the best performing company. It's not as easy as it looks or might feel on paper, or as some others may tell you. And so, again, a lot to unpack there, but a good segue into kind of some of the other conversations that we're going to have later on in the presentation. Transitioning that to diversified portfolios. So I talked a little bit about diversification, buying different asset classes, owning things in a portfolio as an investor. You could see here that no portfolio is going to be made the same, and that's really by design. So the top half of this chart is going to show you the S&P 500, an 80-20 aggressive model, just using Vanguard mutual funds. A lot of these are just low-cost index mutual funds. So looking to track indices and track those certain segments of the market. And so you'll see the S&P 500, an aggressive portfolio, a balanced 50-50, and then a conservative 80-20. And based on that mix, you can see the difference in performance even over the past year. So this is a trailing 12-month rate of return number. You'll see the S&P 500 is by far the best in terms of rate of return over that time period. You'll see that the next highest is the aggressive portfolio, the balanced next, and the conservative is follows that. And these kind of fall in line, I think, the way that we would expect them to as investors, and that the highest risk investment is going to return the most over a period of time. Now, this is a small snapshot. Obviously, this is just a 12-month period of time, but the market looks and feels like it's doing what it's supposed to. The challenge with that is if we look at the bottom half of the chart, this is a representation of the percentage off of high. So put another way, at one point during this year, midway through the year, the S&P 500 was at a peak over that 12-month period of time. Since that date, the S&P 500 index is now just over 6.25% off its high. So it is it has seen the biggest swing over the past few months in comparison to the other portfolios. And they also fall in line this way as well. But my point in showing this to you is that where diversification matters is really in the bottom half of the chart, and understanding the volatility that exists and being able to weather that volatility. So volatility and fluctuations in markets is not necessarily a bad thing. We don't view that as a bad thing. It's part of the natural cycle. But your ability as an investor to see that, recognize it, and stay disciplined and stay the course is ultimately the biggest challenge. And we've talked on previous presentations about the data and statistics behind the average equity investor versus what the market has done. And truthfully, we as investors, and we throw ourselves in that because we are human beings, first and foremost. We have underperformed the market grossly over the past 20 years as individual equity investors. Why is that? And it's 100%, almost 100% attributed to our behavior around investing. And so looking at the market in these short stints or these short snapshots, and then judging the viability or the volatility that we're seeing and saying, based on what's in front of us, I don't think that what I've been doing is going to work anymore. And so now I'm going to change that. In many cases, that can be, going back to our previous slide, that can be one of the worst things that you could do, is try to bounce money around to different asset classes and try to figure out who's going to be better in any particular quarter. It is nearly impossible, even for people like us who have the data and the research, to be able to do that efficiently and effectively on a consistent basis. So this chart just gives you some context. And if you're in a diversified portfolio, this is how you're performing. You're also seeing the differences in upside potential, but also risk of downside loss in different market segments. So let's talk a little bit about forecasts. I had this slide included in our halftime report. And so at the beginning of this year, I think there was some general pessimism based on economic environment, what most analysts thought was going to happen. And so the price target, or the targets that most institutions that you'll see there listed on the left put out for the S&P 500, it was kind of all over the map. But the group average ended up being about 3,800 for the year is what their target was. So anticipating a loss in the broader market, in the broader US market, what's happened is, as of the close of the quarter on September 30th, the S&P 500 was actually around 4288. So ahead of those projections. And I believe it opened this morning at 4237. So we're still ahead of those projections. There's a lot of reasons why. I'm going to cover this on the next slide, but there's a lot of projections and predictions that are happening out there in the world today. There's a lot of noise. And the reality is that there's a lot of things that don't make very much sense. I'll be honest and transparent in saying that. Precedent is hard to look at and use as a measuring stick in some cases when you look at certain segments of the market and what's going on in the world. And there's a lot of uncertainty and unpredictability in markets. And so we have to take that into account instead of trying to predict and look into a crystal ball. We most certainly have to take that into account when we're looking at how we build portfolios and how we, manage clients' money moving forward in an environment like this. So what's changed? At the beginning of the year, there was tons of optimism around sticking that elusive soft landing for the Federal Reserve. There was also some feeling on a potential end to less restrictive monetary policy. And so that basically has been overshadowed by economic data. So the beginning of the year, everybody was kind of surprised by how well things were going, and that drove a lot of market performance. Investors looked at that and said, maybe there is a pot of gold at the end of the rainbow, so to speak. And so what's happened is that while inflation has decelerated quite a bit from a year ago, it still remains elevated, generally speaking, in relationship to that 2 to 2.5% target that gets thrown around in financial news and from Federal Reserve folks as well. So because that is still exceeding that number, there is some feeling that we're not exactly where we need to be, and that there is still a looming possibility of recession. Members of the Fed also continue to comment on monetary policy with a hawkish tone. There's been some indications of this idea of higher for longer is the game plan for now, meaning that interest rates are not going to immediately come down when we flip the calendar over to 2024. There's potential for an additional hike at some point this year. And then potentially locking that in and keeping that rate for an extended period of time through a large part of 2024. It remains to be seen what's actually going to happen. They're using some of the same data that we all kind of have access to. And so there's a lot of uncertainty there in terms of what rates will look like. But it sounds like, based on what we're hearing out of that camp, that higher for longer is going to be the path forward. The market response to that has been a sharp rise in rates, which led to a broad-based decline in both stock and bond markets in Q3. So investors did not react positively to that. A lot of the early year optimism has kind of waned as a result of some of those hawkish comments. And so I think we're back in a position where people are kind of straddling the line of, are we bullish or bearish is the term that gets thrown around a lot. Bullish in that we think there is some room to run and some more upside potential, or bearish that we think we're at the end of that run and we're heading into a recessionary environment where we're going to see, declines in the market. There's no real clear answer on that, no clear path, unfortunately, but we'll talk a little bit more about the data and what we see and what our outlook and what we think your perspective should be as an investor moving forward through this market cycle. So let's talk about bonds and interest rates. It's a topic that gets a lot of attention these days, and you'll see the Treasury yield curve there on the right. Shorter term rates being higher than longer term rates, or put another way, you may have heard by now the term inverted yield curve. You could see on the left-hand side, there's been some changes over the course of the year and the quarter from an interest rate perspective, and you could see where some of those things are falling. 30-year Treasury rates are about 4.73%, while we're seeing 2-year and 1-year Treasury rates north of 5%, 5 and 5.5% respectively. You could see even higher rates and even shorter duration Treasuries as well. And so, what that shows us is that there's some opportunity to get some yield and some return and some interest on your money in a shorter term fashion in this market. But eventually that tide will go out and that will change. And so the question becomes, when is the right time to transition to look at longer term interest rates, and how do we translate that to our ultimate investment strategy? Again, there's still a possibility of another rate adjustment or rate hike, if you want to call it that, before the end of the year. And if it's anticipated that rates are going to stay higher for longer, some of the numbers on this list might be here to stay for a bit, and maybe for another quarter to 2 quarters into next year or another year. Again, we don't know the answer to that, but these are things that will be relevant as we're having more conversations as time goes on about where to deploy capital and where are good places to build portfolios, considering what's available in the marketplace. So I mentioned earlier inflation. You see that 2% target line. We're still well above that, well above that number at this particular point, and so that has led to some pessimistic feelings, and that the Federal Reserve is kind of throwing all they can at the idea of inflation, and things are coming down. I also believe that in some ways, inflation getting down to 2% in a short period of time through tightening monetary policy, it's going to be challenging. I also am of the mindset that U.S. headline CPI is one representation of inflation, but I think we all can agree that inflation is really related to how you spend your money as a consumer. So put another way, if you're someone that works from home and you don't commute, rising oil and gas prices may not matter as much to you if you're not spending money, driving to work, for example. Now, if you live in the Northeast or a colder area of the country, and let's say you're on heating oil, that might matter more because that may be more expensive than you driving into the office. Now you have to heat your home more throughout the day because you work at home. So there's all kinds of different considerations. I always use myself as an example. I don't think I can escape going to Costco, buying groceries without spending like $400 at this point, and that's like several times a month. So, and I have two kids, so two small children, and so I think everyone has experienced things differently. My rate of inflation that I experience every time I go to Costco is very different than what you may experience when you go to the grocery store or how you purchase certain goods. There are definitely certain things in the market that have inflated at a greater rate than this just average headline CPI. So inflation is something that has gotten a tremendous amount of attention over the past few years, but the reality is that the Federal Reserve is using this as their measuring stick for how they want to continue their policy moving forward. And one could make an argument that it's maybe not even a true representation of what inflation is for many parts and many folks around the country. So diving a little deeper into macroeconomic data, let's look at the housing market. This is another one that is getting a ton of attention, primarily because prices of homes just aren't going down. And in many cases, they're actually increasing. So you'll see the Case-Shiller Home Price Index, one that is pretty closely followed and widely accepted. From 3 months ago, over the past quarter, home prices have appreciated 2.17% on a national average basis. That is a that is a pretty consistent increase that we've seen. Even though rates have gone up gradually throughout 2022 and into 2023, we have not seen a retreat. And what we would typically expect in a rising rate environment, you see prices come down to combat that. That really hasn't happened. And so that's creating some challenges, certainly for home buyers and people who are looking for new homes, that are maybe trying to get into properties and move out of cities into suburbs, for example. It's becoming more challenging to do so. Mortgage originations are down pretty significantly in comparison to where they were in 2021. You're seeing that average mortgage rates are rising. So at the end of the quarter, that was about 7.31. Today, that's even higher than what it was when we ran this data. So there's a lot on this chart that that affects maybe even some of you on this call, but many others around the country. And so the average sale price of a home has increased pretty significantly. I mean, 2021 brought the lowest 30-year mortgage rate in decades. Now you're looking at higher rates that have been for many that are now entering the workforce and entering the economy and buying homes, it's the highest they've ever seen. And it's anticipated that this may become the norm for a little while, especially in this higher for longer conversation. So how do how do you combat that? What do how do you work with that? Um, Unfortunately, I think that um, the idea of some like wholesale correction or shift in housing prices to make them more affordable is just not. Um, I don't think that that is a highly likely possibility. It's certainly a possibility, but for all the folks that we talk to and places where we get data, there's no indication that that is imminent. There's a lot of folks that are stuck in, or I shouldn't say stuck, but they're in mortgages that are much, much lower than this, and they can afford those payments. And so it looks and feels very different than things did, in 2008, 2009, where people were kind of over their skis on debt obligations and they didn't have the ability to pay their mortgage. Now we have a different situation where a lot of people are in mortgages where they can afford. They have a great house. It's appreciated a ton, but they really can't move at this point. They feel kind of stuck in that because the cost of doing so is greater than any benefit they would get from selling a property, for example. So some folks in the mortgage industry that we've talked to feel like rates are probably going to be high like this for a little bit. And in fact, probably have some room to go higher potentially before they stabilize and come down. So it'll be interesting to see how this data changes after the fourth quarter of this year. But you can see here that rates are up, prices are up, U.S. housing starts are actually up too, building permits are down. The single family houses sold are also down, which is a big driver of the problem as well. When you look at inventory and supply and demand, which has been a big driver of prices. So a lot of, like I mentioned earlier in the presentation, there's some things that don't make that if you look at the precedent, don't look like they make sense, but there are some other factors at play here that are ultimately going to keep rates higher, and I think prices higher as well. So let's talk a little bit about employment for a second. So, a couple data points that we look at here. So U.S. job openings, unemployment rate. Another one is participation rate. So that's one that the last quarter we talked about and we looked at pretty closely because workforce participation rate was not back to the point that it was pre-pandemic. So pre-2020, we are slowly inching our way back to that place. And so that level was about 63.4%. You could see we're at 62.8% now. So people are getting back into the workforce. There are still a tremendous amount of job openings, and the U.S. unemployment rate, based on how it's calculated and tracked today, is historically low in just for context. And so there's a demand and a need for a lot of jobs, but there's not a lot of people out there to fill them. And so that will be an interesting shift. And we look at hourly wages of employees and earnings and how those increase over time as we get more stiff competition on labor force. It has been widely publicized that wages in the United States have not really kept up with the rate of inflation. If anything, most workers have gone backwards. And so what we've seen in recent history is kind of a recalculation of that, and also an increase, I should say, in how certain people are getting paid. We're still not necessarily caught up or ahead of schedule by very much. So if you look at the bottom half of the chart on the right, that talks to real average hourly earnings. So that's inflation adjusted. Where are we at? And so we're just barely above flat on that. And a lot of that is catch up that had been done in recent history. So all that to be said, are workers finally getting ahead? I guess you could argue yes, but not by much. But there is some room to run on that. We could see some increase in wages, especially in a tight labor market, and as more jobs become available. If participation remains low and unemployment remains low, it's going to get competitive out there. So that could ultimately drive increase in wages and also help combat inflation in some parts of the market as well, but could also drive inflation in other parts where there's more money available now to be spent. So something else definitely worthwhile paying attention to, and something else that we'll be watching closely as we flip the calendar over into 2024. So this particular chart was interesting to me when we were looking at just data points. I titled this slide "Charge It" because this is a representation of consumer debt, and so I hadn't paid particularly close attention to debt indicators. You know, in a low rate environment, payments become affordable, debt usage is kind of normalized in the sense that you can get cheap money. So instead of paying cash, some people were going into debt for certain purchases. But U.S. credit card debt has topped $1 trillion for the first time ever, which I thought was interesting. Mortgage debt, auto loan debt, and U.S. household debt also have set new records. And so what this tells us is we're paying for a lot of things, a lot of our essential stuff with debt. And so in comparison to US GDP, US GDP registered at 27.6 trillion for Q3 of 2023. The national debt clocked in at 32.33 trillion as of Q2 of 2023. So US public debt today is about 120% of Q3 US GDP. Why does this matter? Well, I think we all know and understand that we're in a higher rate environment. And so mortgage debt, auto loan debt, things like that are fixed in nature, maybe not as big of a deal, but credit card debt is in a variable rate environment where rates have been going up. That is something that could potentially be an issue. And so you could look at it one of two ways. We've had some discussions internally about this, actually, of you can look at it through the lens of, as long as people could still pay their bills, the ultimate beneficiary of that will be financial institutions. You know, they'll have the access and capability to make more money on that same debt now that rates are higher. On the flip side, now that rates are higher, that may spill over into payments not becoming as affordable for some consumers. And so it'll be interesting to see on the other side of this if there is some level of default or bankruptcy or other things that happen with some of these debts. Most banks already kind of have those budgets built in for allowances for bad debts and charge-offs, etc. But being that this is a place we've never been before, having $1 trillion of credit card debt, it will be interesting to see how that shakes out and if that has any effect on the markets or economy moving forward, especially if we're going to stay in this higher for longer rate environment. It's also an important behavioral shift, I believe, too, in terms of consumers using leverage or using debt in order to purchase things, and that could be consumer goods. Obviously, homes, auto, major purchases have always been kind of widely accepted, but you're seeing an emergence as well as some of these pay-as-you-go options with, I know Apple has one, and there's a couple others where when you check out at certain stores now, you have the ability to make 4 payments or finance even small purchases at this point. So it's definitely been a shift of philosophy and kind of mindset around debt and how we utilize it. And it'll be interesting to see how that shapes kind of how things move economically moving forward. So a natural question that many have when we look at this stuff is, there's all these economic indicators out there that lead us to believe that recession is probable or possible in the near future. And so one of which I mentioned, the idea of the inverted yield curve. Inverted yield curves pretty much had historically have gone hand in hand with ultimate recessions at various points in time. And so right now we are in an environment, and we've been in an extended period where the yield curve has been inverted. And so there are some metrics or some folks out there that track these things and ultimately track the probability of a recession based on a culmination of different data points. One of which is the Estrella Michigan yield curve and probability tracker, which you could see here on the right hand side. And you could see that at various points it's spiked, and then it looks at probability of recession. You could see that in some cases it timed it perfectly, and sometimes it was a little late to the party. So it is not a perfect science by any stretch, but it is something that has increased, had a pretty sharp increase recently, has kind of drawn down a little bit. It was up to just over 67% at one point. Now it's 56%. But the probability, I think the more important thing that we're looking at is that based on this metric, the probability of, or I shouldn't say success, excuse me, the probability of recession is the highest it's been since the 80s, based on how the data points that this uses to track. And so I think it's widely believed that some form of a recession is probable or possible in the near future. The degree to which that happens and what that looks like in terms of markets as well as the economy remains to be seen. But the inverted yield curve, historically speaking, has been an indication of possible recession. We've been in that cycle a lot longer than we're typically used to before we see those recession indicators or signals. But we are in a place where some of the things we use for tracking and trying to predict probabilities of these things happening are highly elevated and compared to recent historical precedents. So all that being said, lots of numbers and data, lots of thought. What is the actual investment outlook? Like, what can we expect as investors, and what should we be looking out for as time goes on? So from an investment perspective, it was a challenging quarter. There's no doubt about that. But markets still remain firmly in positive territory for the year. So there's a lot to be positive about. I know that there's a lot of pessimism out there in the marketplace, and unfortunately, what often happens in the world of investing that might be a little bit different than other parts of life is that pessimism also can often be confused for logical thought. For example, it seems much more logical as a human to listen to a pessimistic point of view and have someone plead their case of why all these bad things are going to happen. And typically we're more drawn to that in a scenario where we're talking about markets and less in other parts of life. I think in many other parts of day-to-day life, we're looking at positivity as a good thing. And sometimes that creates some skeptics when we talk about investing. But there was a lot of early year pessimism, which really kind of set the bar pretty low for markets and the economy. And so when things look surprisingly resilient, that exceeded expectations by a lot. So on the right-hand side, there's actually something that a data point that's tracked that's called the U.S. Economic Surprise Index. And so at the beginning of the year, relatively unimpressed. We saw that as time went on, the economy was being resilient, that things were going well, and so followed the market. And we've had a little bit of an up and down over the course of the year, and you could see over the past quarter we've kind of drawn back on that. And there is no doubt that there is a disconnect between the strength of the current economic activity and all the elevated warning signs that we see from leading economic indicators. Like there is, like I said at the beginning of the presentation and a couple points along the way, there are some things that don't make a ton of sense all the time when we look at markets today. And I think that partially we need to accept the fact that history, the old adage and kind of the cliche of like past performance is not an indication of future results. That's something you hear a lot in the investment world. The reality is that looking at periods of time, historical periods of time, and trying to mirror that to what's going on today is particularly challenging. The world changes a lot every decade, and that change has accelerated significantly in the past 2 decades, especially with the emergence of technology and the way that we do business and where we do business, globalization, like there's a lot that has changed and that is different. And so what we've grown to understand over time may not always come to fruition. And so that disconnect has been challenging for many investors. And we hear it a lot on a day-to-day basis of like, well, this is happening. It's an if then kind of a cause and effect conversation. Well, this is happening in the market. So there must be something on the horizon that we need to be considering. And in some cases that's true, but in other cases, time over the past year has proven to us that doesn't always work that way. And we've seen where markets can thrive even in a disconnected scenario where there's good economic activity when everything else out there is saying that things shouldn't be this good. And so there are some things to be positive about ultimately. I think one area of historical precedent that we do look at is that sharp tightening orchestrated by the Fed and other central banks is likely to have a negative economic impact. So it's going to impact economic growth across the world. There's no way around that. Tightening monetary policy and taking money out of the economy potentially it's not going to drive economic activity. We know that. We can assume that that is something that we can use as a measuring stick. And so if we stay on this path of a hawkish tone, tightening policy, really trying to drive, like aggressively drive down inflation to some 2 or 2.5% target or whatever they end up landing on, then we can expect that that's going to be a bit of a drawback on some of economic conditions and ultimately could translate to market performance, either in certain sectors or certain parts of the world. So beyond that, what do you do as investors? We are emphasizing continued caution and focus on risk management. So risk management is not to be confused with actively trading portfolios or getting in and out of the market and timing. Risk management is really understanding risk associated with the investments that I'm picking and that I'm using in my portfolio, and then ultimately translating that to, am I comfortable with that? And can I realistically stomach a loss, and understanding what the realistic expectations are too, and what could happen. So if you own just an S&P 500 index fund, for example, it is expected that if 2008 and 9 happened again, which we know over the course of that time, there was over a 50% drawdown in the market. So if you own that index during that time, your money got cut in half. That is a realistic possibility because we know that it's happened before. There is no more, in my opinion, there is no more, it can't be worse than this, or it can't happen again. Now that's not to scare people to say like, that's what's going to happen, but risk management is preparing yourself for the possibility that those things can occur and assuming that you can still invest and grow and build wealth the way that you've envisioned without having to disrupt it because of a short segment of poor market performance, for example. And so it really draws into the idea of discipline and managing, not just managing risk, but understanding risk at a deeper level so that you can pick a philosophy, pick a portfolio, and stick as closely to that as reasonably possible. Something else that we've been talking a lot about is that current yields bonds do offer compelling long-term total return potential. If there is going to be a higher for longer and we start to see longer term debt instruments get better interest rates, there could be an argument to be had there where bonds make their way back into a portfolio for long-term accumulation. I know in the previous low interest rate environment, they didn't get a ton of attention. Nobody really liked them much, but now we're in a place where cash, bonds, treasuries, et cetera, do offer some attractive yields relative to the risk associated with them. And so they are something that should be considered, even if you are a long-term investor, and obviously within an appropriate mix and allocation based on your overall risk tolerance. We still believe that stock has a critical role in a diversified portfolio. I think that we definitely are going to encourage a focus on quality and durability. So looking at companies that have proven track records, strong balance sheets, good cash flow, in poor economic environments, those those tend to be the companies and the stocks that thrive. So making sure that we're giving that focus to quality and rewarding quality and durability instead of chasing unnecessary risk for a potential rate of return that may never come to fruition. For example, certain companies that don't make money but are still, seeing their stock prices surge. We feel like in a volatile, poor economic environment, those things can't always and may not always continue. And then, as always, maintain discipline and conviction, drown out the noise. Like, I think that is the most important thing. There is a ton of noise. There's some people that are optimistic. There are some more of which that are pessimistic, excuse me. It's really hard to figure out who's right. And the reality is that no one is really right 100% of the time. And so you want to look at your own situation. You want to look at your goals, look at the types of accounts that you're investing in too, understanding their purpose, and build your philosophy and your discipline around that. Don't pay so much attention to what happens around the water cooler or holidays are coming up. You're going to have a lot of family and friends around. I think it is important to maintain focus on what it is that you're trying to do and stick with that conviction, regardless of what other people are trying to tell you. And so if you work with anyone, obviously you could talk to them. For those that are clients of ours, we talk about this kind of stuff regularly. But if you're not doing that, I think if you're not working with anyone and you're doing it yourself, there's absolutely nothing wrong with that. I think these rules still apply, and making sure that you're sticking to them, sticking to your conviction and keeping that discipline. And ultimately, if you're someone in an accumulation phase, understanding that this is a small snapshot in time and that there's much more on the horizon. And so investing in any phase of life is still a long-term endeavor. And if you are going to invest in traditional markets, you should view it that way. So the chart there at the bottom, I didn't talk about it, but this is kind of treasury yields over time. And so you could see that has climbed quite a bit over the past couple of years. And so that's where we see some attractiveness, maybe potentially longer term instruments. In this case, a 10-year paying over 4.5%, roughly 4.5% could be a good use of capital in the near term and over the next 10 years. So with that, I'm going to wrap my portion. I'm going to open things up for Q&A. Feel free to drop a question in the chat box, use the Q&A feature in the webinar, and we'll stick around here for as long as we need to answer any questions. If you want me to go back to any slides or revisit anything, just let me know.
Brian, one question just came in asking about commodities. The question is, since commodities have been on a great run recently, how much in our portfolio should they still be allocated to? Is it still a good time to have them?
Yeah. So the interesting thing about historical data is that obviously we're taking a look in the rear view mirror. And so that can provide some challenges. I'm going to go back to that slide here for a second, just to kind of pull it up. That can provide some challenges, some very real challenges when we look at how to allocate to certain things in the portfolio. Our opinion, generally speaking, is that I'm a big believer in diversification. We suggest clients allocate to commodities in some way, shape, or form, whether that's through funds or other types of alternative investment vehicles. I don't believe that it should be a large percentage of a portfolio. It is an alternative asset class, meaning that we're looking at commodities to provide support, hedging, rates of return in periods where other asset classes aren't doing well. And so you can see quarter to quarter, different things are going on in the world and different asset classes are performing. And so typically with that type of investment, we're looking at something in the 3 to maybe on the high end 10% range of a total portfolio, depending on risk tolerance, depending on client profile. But I don't think it's particularly bad to own it. I think it's a tough time to buy into it, certainly, because it has run up quite a bit over the past couple of years. And so you are effectively buying into something at a higher price. It is appreciated. So you're not going to avoid that if you wanted to own commodities. I think there is some practical there are some practical reasons for that. I mean, oil and gas is one area that has seen some significant growth. We feel like there's going to be some higher prices in that part of the market for a lot of different reasons. But economically speaking, supply has been down in terms of reserves. We're a little lower. We're getting into winter months. Demand has increased. And it's a cyclical. I mean, that's just one example. That's a cyclical example of why commodities might make sense, but it covers a lot of other parts or a lot of other things. You can get into like precious metals and things like that. And I think that while it hasn't been overly attractive when we look at the 10-year averages, we have to accept the fact that it's going to perform differently in different economic periods. And so because we don't know what's on the horizon 2-3 years out from now, we still own it. We still recommend owning it in some portion. Again, aligning with an appropriate risk tolerance and what level of exposure you're looking for there.
Another question just came in, Ryan. Concerns that employers have is the ratio between inflation and compensation and skill set variances. What can employers do to stay ahead of the curve, especially when their bottom line is being affected by the market and they need to continue to attract and retain the best skilled talent in their organization?
Yeah, I'd say the short answer to that is you need to get creative. There is it's something we actually heard a lot. We work with many companies on their 401k plans, and when we talk about employee benefits, it gets a lot of attention. Specifically because employers understand that there is an expectation that there's been this kind of rapid inflation in wages, and some of it is regionally specific too. I think in this part of the country, the Maryland, DC metro area, it is a more affluent area by default, and so wages tend to be a little bit higher, and so a lot of it is industry specific, but we're seeing a lot of those questions and challenges. And unfortunately, if you don't have the cash to just pay people, for example, if you're a company that's going to be heavily affected in a recessionary environment and you're now grossing up salaries by 5 to 10% to stay competitive, you're going to hire those people and then ultimately potentially have to lay them off at some later point. And so there's a balance between viability of keeping your business afloat and also keeping your employees happy. And I know that there are some great opportunities there. I think one in particular right now is getting creative with benefits and using things like, for example, there are different types of programs with student loans where you can credit or match student loan payments for employees and make contributions to their retirement accounts instead as a benefit. And that's not going to cost you as much from a payroll perspective as a business, but it's definitely something that is still valuable to the employee, and it's dual purposed, right? They get a chance now that student loan repayments have started again. You get a chance to pay down your student loans, but also still get some savings kicked in towards your retirement. And so you can accomplish two goals at once without having to make sacrifice. We've also seen some more creative strategies around helping employees get savings set up, getting safety net accounts where employers will help get up a payroll deducted savings account, for example, set up for them. They'll throw in, $500, $1,000 a year just to get them started. And then, get the employees on a path to more financial security. I think ultimately that's where things get lost in translation. Sometimes employees don't just want more money. They want financial security. That's really what the money is translating to for them. But if you can find a way to get creative and creatively create financial security for them without having to shell out an extra $10,000, $15,000, $20,000 of compensation, which for anyone that owns a business knows the cost of that $20,000 is a lot more than $20,000. then I think that's a smarter way to do it. And there's tons of ways to do that. And there's tons of resources out there. And we have some great partnerships with folks for anyone that would want to explore or talk about that.
All right, and there another question is: there's a lot of talk about tech and the mega caps floating the entire S&P 500 and other indexes. Some pundits have been saying the time to see big returns here has passed. What are your thoughts on the long-term return outlook for Apple, Google, IBM, etc.?
Yeah, so that's a good point. It's very a very good insight actually, because I will say that most investors don't truly understand that concept, which is when you look at an S&P 500 index fund specifically, it's not quite 500 companies, it's 400 and change that are actually a part of that, 400 large company stocks that exist in that index. And over the past just under a decade, let's call it, there have been a large percentage of the gains in that index have been attributed to a handful of companies. So Facebook, now Meta, Amazon, Netflix was one for a while, Google, Apple, the acronym that was used for some time was FANG stocks. And so that has driven a large part of that performance and has been a big driver of performance in recent years as well. And the biggest concern is that if those stocks don't perform, does the whole index, what does the whole index look like if you carve those out? And reality is that it's not as attractive. And so how we're addressing that, or how, what our kind of like thoughts or opinions are on that, are really centered around the idea of, one, diversification. I think the outlook on some of the companies that you mentioned, that you read off there, Devin, is still actually relatively strong, primarily because we're seeing this transition into a period of artificial intelligence has become more prevalent in many businesses, not just in the tech industry, but I couldn't tell you how many service-based businesses I know, for example, that use ChatGPT in some way, shape, or form. And so there are a lot of businesses out there that are transitioning to these AI based technologies, platforms, and the companies like the Apples, Googles, and IBMs of the world, and others like it, are all taking a pretty big chunk of R&D budget and money and throwing it into that pot. And so there's a very good chance that could still drive some growth for those individual stocks. As far as the broader index as a whole, I would argue that we're kind of in a market where selection is key, in that if your expectation is to track the index, you can absolutely do that in an index fund. In terms of riding the wave, though, and having like too much exposure, for example, if your concern is having too much exposure to tech or growth stocks, unfortunately, the S&P 500 is heavily weighted and top heavy with those companies. And so it's a case by case based on the investor. Our outlook is still generally positive on some of those companies. I don't think that we're going to see years of 40% growth, year over year forever. I just don't think that's sustainable for any company. But I think in the short term, there is some validity to say, like, there's been a pretty good run. This may not continue for an extended period of time, and that ship may have sailed to some degree. But because the S&P 500 index is made up of a bunch of other companies as well, that doesn't mean that that's a reason to get away from that type of investment. There's still an opportunity for some of those other companies that exist in the index to have good years of performance and potentially prop up return, even if an Apple, Google, or some of the others you mentioned do have a down year. The collective index could still return a pretty attractive rate of return potentially. That's not, obviously, never guaranteed. And there has been the S&P 500 has been in existence for enough time where these companies have not always been the driver of growth. And capitalism is such that there will be a cyclical nature to this. Some of those companies you mentioned probably not going anywhere anytime soon, but there will be others that will emerge inevitably and that will, you know, take a significant seat at that table, so to speak, in terms of how they drive index performance. I mean, Tesla is a prime example of that in recent history, where obviously they've had a very, very strong run. They've grown. Their market cap is, you know, humongous now, but it didn't always exist like that. It didn't start that way. And so my outlook generally on index funds is that having realistic expectations is probably the first key, and that understanding that you are buying a broader index and you have no control over the underlying performance of the stocks that exist. And you also don't have control when they do really, really, really well. So I think that growth, you know, you get into this conversation of growth towards value, which the S&P 500 is kind of both mixed together. I think there's a pretty decent balance between the two, where the performance of that particular index might not be as strong year to year, but it's not if it's something you're looking at from an investment perspective, it's not something to shy away from as a result of anticipated downturns in the technology or growth sector, for example. Sorry, I was just reading through that question again. So, the time to see big returns has passed. Yeah, I would argue there's always opportunity to see returns in the market. Some are big, some are, I mean, you could see here. Look, I mean, the US growth great this year, large portion of that growth stocks, S&P 500, 13.1 at this particular point when this chart was created, a mix of growth and value. There's, you know, arguments for any of these potentially not being a big earner, or not being a great place to invest. But, you know, you could have said that about commodities, for example. And if you had done it in recent history, you had an opportunity. I mean, at one point, in previous years, we've had this conversation with clients that didn't have a great belief in real estate in their portfolio or commodities. And in those years, those asset classes, you know, ripped off 40% returns in some cases. So it's not a reason to shy away from anything, is my point. And I'll just kind of button up that question with that portion of the answer. But I know we're over time. I appreciate all the questions. If anyone has any others, we'll continue to stick around. But we appreciate everyone taking time out of their day. This is, as I mentioned before, a recorded session. We're going to circulate this around to everyone that we had on the call, as well as the slide deck. And feel free, if you have any other questions that you'd like to ask us offline, we're here, happy to provide some additional context or answer some more specific questions about the slides in a one-on-one capacity. So if there's not anything else, like I said, I'll stick around for a few more minutes, but we appreciate it. And hopefully everyone enjoys the rest of their week and is getting ready for the upcoming holiday season. And now it feels like winter is here in Baltimore. So it's we're accelerating our way to the end of the year.